Europe's leaders are meeting in Brussels right now to try and tackle the region's debt crisis. Investors seem to be rather confident that the EU can handle it, but can they really? And what could it mean for all of us investors? Some perspective now from a pair of investing pros. With us here in our New York studio, Mark Dow, portfolio manager for Pharo Management. He has served as an economist for the IMF, also the U.S. Treasury. Also back with us, Mark Grant, managing director at Southwest Securities. Executives and investors all over the world read his daily newsletter, Out of the Box. He's in Fort Lauderdale, Florida. So a pair of Marks, great to have you back with us. Mark Grant, I'm going to kick it off with you. Can the EU handle... Can the EU handle this continuing unfolding mess over in Europe?
No, I don't think it can. I think what's happened is we've seen first Greece, then Ireland. We've seen the smaller countries, the periphery countries. But now you're going to really get down to it. Now you're going to get down to Spain, the fourth largest economy in Europe. And if there's issues there, which I think there certainly are, both in terms of their sovereign debt and their bank debt, then I think you're really going to get up against the wall.
Mark Dow, we're going to be up against the wall in your view?
No. I mean, I remember I was last on with Mark a few months ago, and collapse was imminent. It's always imminent. Actually, I think we're in a better place than we were then for three reasons. Then I thought they could stave off systemic risk. They had the tools with which to do it, even though Portugal needed a program. Now the situation is even better for the following reasons. Back then, there was technical selling. The natural longs that held these bonds were getting out on a day-by-day basis. Even if the euro was rallying, even if the stock market was rallying, they needed to get out, and they've cleaned up their positions by the end of the year. So this is part of the reason why you get bad news and you don't see selling in the bonds the same way you saw last year. Second, the Europeans, for the first time, have put together a comprehensive set of tools to deal with this. Now, it's only going to buy them time. The homework has to be done by the Spains and the Greeces and the Irelands and the Portugals of the world. But they bought time to stave off systemic risk. And then the third thing, and this is actually the most important point, it's the most subtle. The U.S. is in a much better place. Last year, when Europe was falling apart, everyone was convinced on its own the U.S. was going to double dip. And for sure, if Europe fell by the wayside, now people think, okay, the recovery may not be great, but at least it's on relatively solid footing, and it'd be harder for Europe to knock us off our track. And that's why when we see bad news out of Europe, people don't panic across the world in all asset classes the way we did last year. And it's not attractive for hedge funds to go after European credit and short it the way it was last year. And since the technical selling has taken place by the natural longs, we don't see bleeding there. And this is part of the reason why it's a little bit more manageable than was the case.
Mark Grant, I mean, that is the case, that you don't see the panic in the markets. We definitely didn't feel it yesterday, and we don't really see it today. Why is that?
Well, I think, to address Mark's position, and I have great respect for Mark, I think his point about the United States being in better shape is 100% correct. I think, however, if you look at the bonds, the sovereign debt of Ireland, of Greece, of Portugal now, they are the highest levels within the last week that they've ever been. So you have to say that the shorting goes on. I don't think it's as in great spikes as it was at one point, but the shorting certainly has gone on. But now my point is not that the world is falling apart, but we're now going to get to Spain. Everybody's going to look at Spain. Everybody's going to look at Italy. And if those two countries, which have very large economies, start having real issues and the investors flee from the bonds, I'm not saying that the world is going to hell. I'm just saying we're going to have problems.
Well, and hang on. I mean, you saw those charts, right?
Yep.
Their financing costs are getting unbelievably expensive.
Yeah, why?
Maybe unmanageably expensive.
They're not borrowing at those rates, right? Those are artificial rates. Now, they keep going wider because there's no one interested in buying this paper, and the only buyer out there is the ECB. Whether that's right or not, that's what's happening. Greece is going to get restructured, almost for sure. I believe this from the beginning. I believe Portugal needs to get restructured as well. So these bonds, in some way, shape, or form, they might fudge it, but
default.
In some way, shape, or form, they're going to need to restructure their debt, it seems to me. Why? Because they don't have growth. And it's going to be hard for them to generate it because they have a competitiveness problem. Ireland is in a much better competitiveness place because unit labor costs are much more attractive. They've taken a lot of the hit already. Also, they have a much more, at least in relative terms, a more credible policy framework. So Ireland, I think, will make it. Portugal has to get restructured. And Greece has to get restructured. Now, Ireland, if and when they cut a deal between the EU and Ireland, then I would expect spreads to start coming in. And I actually think it's an attractive point for the first time ever to start getting long Irish debt. I wouldn't touch Portuguese debt. I wouldn't touch Greek debt. Spanish debt is not very attractive the way it's priced, although I think Spain will come out clear because their sovereign balance sheet is in better shape. Their problem is primarily with the banks. So,
Mark Dow, you're saying no matter what, something's going to be done. It's going to be dealt with. It may take some time or whatever, but it's going to be dealt with.
Yes, and I think it's going to be sluggish. Growth will be difficult. Fiscal consolidation will hurt. It'll be a long, drawn-out deleveraging process like the one we're having in the U.S. But I think in the cases of Ireland and Spain, they're going to avoid restructuring. Portugal and Greece, no.
Mark Grant, let me bring you back into this. I mean, when do the stronger European nations, a la Germany, say enough is enough? I'm tired of bailing out everybody.
Why haven't they already? Why hasn't Angela Merkel said that already?
Well, I think that you're beginning to see that. I mean, all you have to do is look at Germany, look at the 7 state elections that are taking place this year, look at the way Merkel's party is being received, and you're beginning to see Germany saying, we're not going to spend all of Germans' money funding all these countries. Now, the amounts of money are relatively insignificant, but I still make the point that if you get to a Spain or you get to an Italy, things are going to change in a radical fashion for the worse.
That's for sure. That's got to be true.
I'd like to know what probability he puts on that, because it's true as a statement. If we get to Spain and Italy, things get bad. They have the tools with which to deal with Spain if need be. I don't think it's that probable, but they have those tools. They don't have the tools to deal with Italy, right? Well, so again, what probability you put on that is the big question.
Especially if the German people say, "Forget it, we're done with."
Mark Grant, what probability do you put on that?
I put someplace between 40 to 50%. I disagree a little bit with Mark in terms of the structure. I do not think, at least at this point, that the EU has the financial capability to deal with Spain and the tremendous amount of money. You're probably talking $400 billion just for Spain if you look at the numbers. I don't think they have the capacity at this point to deal with it, and I don't think that a lot of countries such as Germany are going to want to put up the money to bail out some other country in that size.
Well, I think running the numbers, they have enough to deal with Portugal and Spain, right? But I think the probability of getting to that point with Spain is much lower because the problem is not with the sovereign, it's with the banks. And the Spanish have taken steps on that side.
Because of the real estate you're talking about.
Yes, and most of the cajas, the local savings banks, have been the ones in trouble, and they have to they really have to recapitalize or they get taken over by the state by September. And the state, unlike these other countries, with the exception of Ireland, started with a very good balance sheet. So they didn't start with a high level of debt. So they do have more room to deal with that problem. So if the states can be solved, even though growth won't be as good in Spain as it's likely to be in Ireland, they can deal with it better because their initial debt burden was good.
Mark Grant, saved the last few seconds here for you.
Mark Grant says that this is a subject that Mark and I disagree about as gentlemen.
I was thinking we need to take you guys out for beers. Carol and I would sit in between you, obviously.
We'll hook up on Mark Grant's boat. All right, guys, we do have to leave it there. Mark Dow, Mark Grant, guys, we do like talking to you about this subject. Thank you so much.